Hi guys, happy Visa Day holiday and welcome back to this week's Technical Insight. With the local Singapore market taking a break on Friday and the non-farm payroll announcement happening in US, let's catch up with some of the movement in the major US indices. On Friday, US equities continue to defy logic, rising higher and higher, led by a handful of technology stocks and more recently the AI-related stocks. During the last week, the Fed provided equity market with a nice tailwind as two Fed voting officials signaled their preference for a skip or a pause at this month's FOMC meeting happening on the 14th of June. In addition, any lingering concern weighing on the risk markets dissipated on a bipartisan agreement to suspend the debt ceiling was achieved at the 11th hour. The non-farm payroll data on Friday provided another reminder for the resiliency of the US labor markets, as the month of May brought in 339,000 jobs in contrast with the median economist expectation of 190,000. April's figure of 253,000 was also revised higher to 294,000. A tight job market suggests that the Fed efforts to calm the inflation is far from over, with suggestion that the committee could be swayed to hike once again this month. The dollar traded higher in the moments after the non-farm payroll data was revealed, and that tends to usually negatively impact the indices. But that's not the case on Friday. Market participants may be focusing on the fact that average hourly earnings failed to move higher, and the unemployment technically moved higher despite the job addition. The market cap weighted indices continue to be dominated by moves in large market cap tech stocks, while the majority of the index hasn't been faring that well. The current number of companies that are outperforming the S&P 500 index stands at 29. It is lower than during the COVID period in 2008 and only slightly above the level observed in the lead-up to the dot-com bubble. All three major stock indices closed the day higher on Friday, with optimism that Congress approving the debt ceiling deal and the Fed officials signaling a pause in the rate hike. The Dow Jones Industrial Index rose 701 points, or 2.12% to 33,762 points. The S&P 500 gained 63 points, or 1.45% to 4,282 points. The Nasdaq Composite Index added 139 points, or 1.07% to 13,240 points. For the week, the Dow Jones added 2.02% and the S&P 500 rose 1.82%. The Nasdaq Composite gained 2.04%. So let's move to the chart of the S&P 500 and the Nasdaq Composite Index. The S&P 500 index broke above a rising wedge on Friday before the close after gapping higher at the open. Price action had previously shown a reluctance to break higher and only managed a gradual grind higher until Friday advance. The RSI showed a move towards the overbought territory, which suggests there could be still room for a continuation of the latest impulse. The move has the markets in some clear air, as it would seem, with the August 2022 high of 4,325 points as the next level of resistance for the S&P 500 index. Naturally, support will reside at the prior resistance level of 4,195 points. The weekly chart helps to view the broader uptrend of the S&P 500, which has struggled to show a preference for a strong directional move. The current bull trend originated in the later stage of last year, attempting to retrace the major sell-off that ensued March of 2002. Hence, a pullback of towards the 4,000 points is still in the picture. Next, let's move to the Nasdaq Composite Index. The Nasdaq Composite Index, like the S&P 500, put in a decent move higher to end the week up 2.04% at 13,240 points. Although it appears to have risen to a lesser degree compared to the S&P 500, this could be due to the parabolic rise rendering in the overbought territory of the RSI indicator. The index embarked on another leg higher after breaking out of the channel that was a consolidation which developed throughout the months of April and May this year. The steepness of the moves now seems that the Nasdaq Composite Index breaching well into the overbought levels, which market participants keeping an eye on will be eyeing a potential pullback in the event some traders decided to reduce their exposure at such elevated levels. Resistance appeared at the 14,260 point level, which corresponds with the high in the February and March high of 2022. Immediate support would naturally become the double bottom formation in the February and March period of 2022, around the level of 12,555 points, and also the prior resistance that you see this year during the January high, as well as the May high around the 12,269 points level. So with that, we come to the end of this week's video. I hope you enjoyed this week's update. If you find the video useful, do give us a like and a share. In the meantime, as always, trade safe, and I'll catch you again next week in the next Technical Insight.